The mortgage is paid off, Social Security is coming in, your IRA has grown to $480,000, maybe more. You worked 30, 40 years for that number. You protected it through market crashes, through recessions, through every financial storm that came your way. And now you're finally ready to use it. So you make one withdrawal, a single, logical, completely reasonable withdrawal. Maybe it's to help a grandchild with tuition. Maybe it's to fix the roof. Maybe you just want a little breathing room after years of watching every dollar. And then the letter arrives. It's from the IRS, and the number inside it, the amount they say you owe, is nothing like what you expected. It's not just the taxes on the withdrawal, it's a cascade, a chain reaction, one that reaches into your Medicare premiums, your Social Security benefits, and possibly your Medicaid eligibility in ways you never saw coming. You didn't do anything illegal. You didn't make a reckless decision. You simply didn't know about the trap. And starting in 2026, that trap just got bigger. Here is what most retirees are not being told. The tax code has never been designed to protect you. It was designed to collect from you, quietly, systematically, and at the exact moment you are least able to afford it. And in 2026, a combination of expiring tax provisions, new IRS enforcement priorities, and updated income thresholds is creating a perfect storm for retirement savers. One large withdrawal from the wrong account at the wrong time can now do three things simultaneously: spike your taxable income, trigger IRMAA surcharges that raise your Medicare premiums for an entire year, and expose more of your Social Security benefits to federal taxation, benefits you've already paid into your entire working life. One withdrawal, three consequences, each one invisible until it's too late to reverse. This is not a fringe scenario. This is the retirement tax trap that financial planners are now calling the most dangerous oversight in modern retirement planning. And the people falling into it are not careless. They are careful. They are exactly like you. So, how does this happen? How does one reasonable financial decision create this kind of damage? It starts with how the IRS measures your income. Not your take home income, not what feels like your real income, but something called your combined income or provisional income. This is the number that decides how much of your Social Security gets taxed, what Medicare bracket you fall into, and how aggressively the IRS treats your retirement distributions. And here's the part that catches people completely off guard. Your combined income is not just your paycheck or pension. It includes half of your Social Security benefits, all of your IRA withdrawals, investment income, interest, even income from certain municipal bonds. The IRS adds it all together and measures you against thresholds that have not been adjusted for inflation in decades. That means thresholds set in the 1980s are still being used today to determine how much of your Social Security is taxable. Retirees who were never supposed to pay taxes on their benefits, people living modestly, carefully, responsibly, are now crossing those thresholds simply because of inflation, cost of living adjustments, and the natural growth of their retirement accounts. In 2026, with several key provisions from the 2017 tax law expiring, the standard deductions, bracket thresholds, and estate-related protections that millions of retirees built their plans around are shifting. Quietly, without fanfare, without anyone sending you a personal warning. The system is not malicious. It is simply indifferent to you. Let's break down exactly what happens when you pull that trigger on a large withdrawal, because it doesn't happen all at once. It happens in layers. Say you have a traditional IRA, pre-tax money, money you never paid taxes on because you contributed it decades ago when you were told you'd be in a lower tax bracket in retirement. You probably are in a lower bracket until the moment you take a large distribution. One withdrawal of $60,000 doesn't just add $60,000 to your income. It can push you into a higher marginal bracket for every dollar above the threshold. Suddenly, income you expected to tax at 12% is taxing at 22%. And that's before anything else happens. Medicare uses a system called IRMAA, Income-Related Monthly Adjustment Amount. It looks back at your income from 2 years prior and uses it to determine your Part B and Part D premiums. If your income in 2026 spikes because of one large IRA withdrawal, your Medicare premiums in 2028 could jump by hundreds of dollars per month, not per year, per month. A retiree paying $174 in standard Medicare premiums can find themselves suddenly paying $384, $550 or more for an entire year, with no recourse and no appeal unless they can prove a life-changing event. That one withdrawal didn't just cost you its tax rate. It cost you an additional $2,000 to $5,000 in premium surcharges that follow you into the future. Here is the one that truly shocks people. Up to 85% of your Social Security benefits can become taxable based on your combined income. Most retirees don't realize this. They see their Social Security deposits hit the bank and assume that money is theirs, earned, protected, untouchable. It is not untouchable. When your one large withdrawal pushes your combined income over the threshold, $34,000 for single filers, $44,000 for married couples, up to 85 cents of every Social Security dollar you receive becomes taxable income. That's money you already paid payroll taxes on for 40 years. Now the IRS is taxing it again. One withdrawal, three traps, and every single one of them compounds the others. Let's put real numbers on this so you can feel what we're talking about. Meet Robert and Margaret, both retired, both 69. Similar situations, similar account balances, about $450,000 in traditional IRAs each. Both want to pull $75,000 to help a child through a financial hardship. Robert moves fast. He calls his brokerage, requests the full $75,000, and doesn't think twice. His combined income for that year, including his $28,000 in Social Security, crosses $103,000. He lands in the 22% bracket. 85% of his Social Security becomes taxable. His IRMAA surcharge kicks in, raising his Medicare premiums by $370 a month 2 years later. His total real cost for that $75,000 withdrawal, closer to $98,000 when you account for the taxes, the premium surcharges, and the additional Social Security taxation he triggered. Margaret does the same thing, but she plans first. She spreads the withdrawal over 2 tax years, taking $37,500 in December and $37,500 in January. She keeps her combined income under the critical threshold both years. She stays in the 12% bracket. Her Social Security taxation stays at 50% instead of 85%. Her Medicare premiums don't change. Same goal, same amount, same retirement account. Robert paid an extra $23,000 for the exact same outcome. The difference wasn't income. It wasn't luck. It was timing and knowing where the traps were buried. So what do you do? How do you protect yourself from a system that was not designed to warn you? Here is your defense plan. First, map your income thresholds before you touch anything. Know exactly where you sit before adding any IRA distribution. Add up your Social Security, your pension, your investment income, and any part-time earnings. That number is your baseline. It tells you how much room you have before you cross into dangerous territory. Second, split large withdrawals across tax years whenever possible. December and January exist in different tax years. A 2-calendar-year strategy can keep you out of the IRMAA trap and below the Social Security taxation cliff. This alone can save thousands. Third, ask your advisor or tax professional specifically about Roth conversions in lower income years. Converting traditional IRA money to Roth during a year when your income is low voluntarily triggers a taxable event on your terms at a lower rate and creates future tax-free income that never shows up in your combined income calculation again. It is one of the most powerful tools available and one of the least used. Fourth, review your Medicare premium bracket annually. If your income dropped due to retirement, divorce, spouse death, or loss of income, you can appeal your IRMAA surcharge with a life-changing event form. Most retirees never file it. Most never know it exists. Fifth, if you anticipate a high-income year, protect your Social Security from the 85% tax trap by coordinating your distributions carefully. Do not let a single careless withdrawal push benefits you earned for 40 years into unnecessary taxation. And finally, retitle any accounts in a trust or consider the role of qualified charitable distributions if you are 70 and a half or older. A QCD allows you to send up to $105,000 directly from your IRA to a qualified charity. It counts toward your required minimum distribution, but does not appear in your adjusted gross income at all. It is one of the cleanest tax reduction strategies available to retirees, and in 2026, with expiring provisions tightening the brackets, its value has never been higher. The IRS does not send warnings. The Medicare system does not send reminders. The rules change quietly, the thresholds shift silently, and the consequences arrive in the mail 2 years after the mistake you didn't know you were making. The 2026 rule changes are not theoretical, they are coming. And for retirees with significant IRAs, paid off homes, and modest Social Security income, the combination of expiring tax provisions and unchanged income thresholds creates a window of danger that could cost some families tens of thousands of dollars. Money that was supposed to go to them, to a surviving spouse, to their children. You worked too hard to lose it to a trap you never knew existed. One withdrawal, timed wrong, in the wrong amount, from the wrong account, can set off a chain reaction that follows you for years. But one conversation with the right advisor, armed with the right questions, can stop that chain before it starts. If this video warned you, if something here made you think of your own situation differently, save it. Watch it again. Send it to someone in your family who is approaching retirement or already in it, because the people who get hurt by these traps are not the uninformed. They are the careful ones, the ones who did everything right, who simply never knew the trap was there. Subscribe for more retirement warnings and protect what you spent a lifetime building.